Bloomberg Audio Studios. Podcasts, radio, news.
This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. Early childhood education is as important as it is challenging for millions of Americans. It turns out that it's also an investment opportunity. We look at the large and growing role of private equity in raising our children. Plus, what that one big beautiful bill means for childcare and healthcare. Our special contributor, Larry Summers, takes us through where he thinks we may be going wrong. And the World Cup is coming to North America with all the excitement, all the potential, and all the costs surrounding it. We bring you to the host city of Toronto to hear why it thinks it's making a sound investment. But we start with the question puzzling so many investors these days. Why are the U.S. equity markets poised for growth while economists are predicting a slowdown? Rick Rieder is BlackRock's Chief Investment Officer of Global Fixed Income and head of the Global Allocation Investment Team.
The service economy is what drives this economy today. It's not a goods-oriented economy. It's not a commodity. It's not an export-oriented, not a heavy manufacturing, service-oriented. So most of what drives the economy is resilient to what is a goods, slowdown in goods. Second thing that I wouldn't have anticipated, I would have thought you've got more pricing transmission in, but it's pretty incredible how companies moved. In fact, now some of it in the near term, companies took it into margin.
So give us a sense, Rick, of where this economy is headed, because if you look at the stock market, it looks really good. It's really going places. At the same time, if you look at the markets, they say, well, we're going to have a rate cut or two this year. Normally you wouldn't cut rates into a robustly growing market.
So it's pretty extraordinary. I mean, it almost never happens in time. So there are a couple of things happen. First thing, I think all financial assets, there's an extraordinary amount of cash and money that has to flow somewhere. And the technicals in equities are great because companies are buying back their stocks. So I think the equity market is reflecting really good technicals. Earnings have been pretty good. But I think there's something different at play in terms of inflation. What's going to happen with productivity and innovation, inflation is going to come down. And the reason to bring interest rates down, which I'm a believer in, is the housing market is under pressure. So the real impact of interest rates on the economy today, I don't think it is in the historic sectors of who spends on CapEx, you think about AI spend, how the banks manage the risk. It's about housing. And today, if you look at the housing market, and particularly what impacts lower income, the people that borrow today are lower income, and they're adversely infected by where these rates are. If we get the rate down, you actually can bring home prices down, you build more houses, you'll actually reduce inflation. So I think it's quite consistent to bring the interest rate down, even though the economy is operating at a pretty good level. Where we're going is to a lower level of inflation, and I think we can bring it down. I mean, you think about inflation break-evens today, depending on which part of the curve, are 2.5 to 2 3/4. So the funds rate, even if you bring it down to 3 1/4, you're still above the rate of inflation. So I think we got plenty of room to drop it, even though the economy's operating well.
Does the yield curve on the Treasury indicate we do have a bigger problem with inflation than we think? Look at the 30-year, for example. We're significantly over 5 now. It's hanging in up there. So the short end, nice under control. Long end, not so much.
So I think the long end of the yield curve becomes untethered. First of all, the Fed generally can control the front end, and the front end stays tethered to the Fed funds rate. Long end of the yield curve has a couple of things that I think are not to its benefit. One, we've got to issue a lot of debt going forward. I mean, think about the size of the bill, the size of the deficits. We're going to issue a lot of debt. The long end is a hard place to invest. It used to be that the long end protected you against the equity market. If inflation ends up being higher, which I don't necessarily anticipate, then what will happen is equities and long end will get hit. So the long end of the yield curve today, given that you can get so much yield if you're an investor in the front end, the long end doesn't become that attractive.
You said one of the problems with the long end of the yield curve is actually how much debt the United States government has to take on. And the so-called one big beautiful bill doesn't seem to be helping that situation much. How big a problem is that, and how much of the problem right now we're seeing is particularly a term premium? People are starting to doubt a little bit whether we're going to repay it.
So there's only one way to delever the economy. You've got to outrun the debt. You've got to outgrow it. So there is a plausible outcome where you get nominal GDP running at 4.5 to 5. If we get that interest rate down to 3, gosh, now you could start to delever, but it takes a really long period of time. Listen, I think the one engine today, since we are going to have a bigger debt burden, and not only are we going to have a bigger debt burden, you have to fund it domestically because international doesn't buy as much. As long as we grow, then you could work through it. You know, what I worry about is you get shocks to the system.
So how big is AI? I mean, you mentioned that's CapEx, a lot of CapEx going for it right now, a possible engine for growth, I guess in productivity,
Yes.
principally, right?
Yeah.
How big could that be?
I think if you take, with AI, you take robotics, you take automation, you take software, you take cloud, you take energy, you take cooling. I think people underestimate how dramatic this is going to be. And I think our world, a year or two hence, is going to see things that nobody's ever seen before in terms of innovation, productivity. And you think about what happens, the things that, everybody talks about autonomous cars, but you talk about all the services, all the things that can be created at a lower price point. I think it's remarkable. I think it's remarkable. Part of why we talk about, who do you own in the equity market? These big cap companies that utilize data effectively. It doesn't have to be necessarily the Mag 7, although they're pretty good companies generally. Gosh, you think about the companies that utilize data to expand their moat and how they utilize, the price points they got to operate at, how they advertise, how they run their business efficiently using software, et cetera. Part of what I think this is the most exciting investment period I've ever been around. We're going to see more dramatic change than internet, than mobile telephony. It's a pretty amazing time.
You mentioned internet, which is the last time I remember, at least, when there was really a substantial increase in productivity in the late 90s into the early aughts we saw. Is AI bigger than that?
So, there's an interesting thing around. I've spent a lot of time thinking through this. Internet took some time to develop, and the adoption rate, and by the way, if you go back in time, electricity, telephone, rail, it all took a period of time. This is almost instantaneous, how fast. And by the way, I think one of the incredible technologies of the last couple of decades was GPS technology. Part of why I literally get up every morning and in the weekends, and you try and think about which companies are going to benefit from all these new companies that are coming about. Listen, I think it's going to happen faster and be more profound. It's hard to say. The internet was pretty incredible. It's hard to say it'll be bigger, but it's certainly going to happen faster.
But the market must be pricing in some of that already. We're seeing a lot of the AI already. Why are you confident it's not pricing all of it in?
If you go back to the internet bubble, you go back to 98, 99, 2000, you were putting multiples on no cash flow. Most of these companies today, so first, certainly when you look at the Mag 7, and you look at the multiples on those companies, actually they're not that scary. I mean, when you assume their growth rate, these companies throwing off 30, 35, 40% return on equity or higher for a couple of them, and you're throwing off cash, which by the way allows them to buy back their stock. You think about those companies in the 98, 99, you were sort of hoping that they would take off, and most of them didn't. These companies are well entrenched. Now you go into other areas and you think about, gosh, there are some parts of it that are a bit of a flyer, and there are some multiples on some things. And so that you have to evaluate, what is the business prospect, what's the available market. But I would say that the big hyperscalers, the big semiconductor companies, the big software companies, and I would argue, even the companies that utilize data efficiently, even the huge retailers, media delivery companies, they're pretty spectacular as to their rate of growth and making money along the way, and that's different.
Given that view on the economy and the markets where they are, where they're headed, what's the best way to invest? Give us your perspective from BlackRock.
Yeah.
What are you seeing that's particularly attractive right now?
So, I still believe in growth and technology and equities, and I think, running more of a barbell that is, I don't like a lot of the small cap equities that there's some in some areas that are okay. I like these big cap, particularly in and around tech. By the way, healthcare, technology. By the way, leisure and hospitality. I think the world, part of this, the derivative of AI is people have more time. Leisure, travel, entertainment, I think is a big part. So that's what I like on the equity side. While I think rates should come down, I'm kind of hoping they don't. Because this environment, we can build 6.5%, 7% yielding assets or portfolios that don't really have to stretch and that can stay in investment grade generally, on average. If you could buy growth and income, and then by the way, maybe a little bit of hard asset, whether that's gold or some crypto, not scaled to the size of your debt and equity, but I think that creates balance in a portfolio.
You mentioned crypto, which has become quite the topic in Washington these days, and particularly stablecoin, because all of a sudden everybody wants a stablecoin, it seems like. Is that really fundamentally going to change the financial system?
So crypto or stablecoin or both, I mean, they're related. Stablecoin, I actually think, will be quite helpful in that it will utilize it. A, there's a benefit to the currency and the dollar utilization ultimately. B, it will soak up some of the, we have a lot of treasuries we've got to issue. It will soak up some of that. Not a tremendous, but it will soak up some of that. So I think that'll be real utility. How we moved in the tokenized assets and tokenized investments, how we think about payments mechanism, I think stablecoin will be a very big deal. Crypto, I think, general crypto, I actually think, I own some of the portfolios, you talk about volatility, I own it in moderate size, but it's one of those things, the adoption rate around the world is so extraordinary.
Coming up, we trust an awful lot to the markets, but does that include caring for our children? We look into the growing role of private equity in early childhood education. That's next on Wall Street Week. This is a story about having the markets raise our children. Since the days of Adam Smith, we've trusted the invisible hand to do all sorts of things for us, from telling us when our government is borrowing too much.
The 93 deficit reduction program, it was very heavily focused on deficit reduction, and I think rightly argued, and it turned out to be correct, that markets would react very favorably if we were serious.
To guiding us in our career path.
The number of jobs that we've created in life sciences over the last couple of years, we've seen thousands of new life sciences jobs in Jersey. But we're making major investments because we know it's a crowded field.
Another fuck sound.
As parents, our children are priceless, which means that any value attached to them or their well-being cannot be enough. But there is a business built around early childcare, with consumers and suppliers setting prices based on revenue and costs, and even investors putting up capital on which they expect a return.
I was kind of like at my wit's end at the end of 2024. I had taken a break from real estate because I was like, I don't know how to do this without full-time childcare. Hey. And I just remember opening up my journal, and the first thing I wrote down was like, find childcare. And then I was like, I don't know how to do this. The eggs are done now.
Ashley Purdy's kids are one of roughly 11 million children under the age of 15 who spend time in paid childcare in the United States.
Shoes and then car. Being home with 3 kids was amazing for a time, but then it was like I would be home just like daydreaming and like fantasizing about going back to work.
Childcare is uniquely expensive in the U.S., comprising a higher proportion of average income than it does anywhere else in the world. According to Child Care Aware of America, the national average cost for children under school age for 1 year was $11,582 in 2023. But that cost is only the tip of the iceberg.
This isn't a gym, right? This is a sector where educators are literally building the brains of young children and providing the care that families rely on to be able to flourish.
Elliot Haspel is a senior fellow at Capita and author of the forthcoming book, Raising a Nation.
Right now, we see middle income and upper middle income and affluent parents using licensed formal childcare. Largely that's because they can afford it, or at least try to afford it, and also because those tend to have the highest proportion of families that have 2 earners in the workforce.
What can be a major challenge for young parents turns out to be a potential opportunity for equity investors.
They take up right now somewhere between 10 to 12% of the child care sector, and they're growing. At a time when many child care programs are struggling to stay open, the for-profit chains are growing because they're able to do debt financing, right? They're able to access capital markets in a way that the individual programs, nonprofit programs, church-based programs just can't.
The strong demand for early childcare is one way for private equity investors to make money. But there is another potential revenue source, the real estate the centers occupy.
Classic sort of part of the private equity playbook that we know in other sectors is what are known as sale leasebacks, right? This idea that you take a site that owns its own facility or owns the land and basically force it to sell off to another landlord. The profits from those sales go up to the private equity firm as opposed to back into the site. The site now has to lease back the facility or the land that they previously owned, so they now have a new line of debt. We have definitely seen this strategy play out in childcare, and in fact, childcare real estate is one of the most valuable pieces of sort of assets that many of these chains have.
Adam Newman is founder and managing partner of Titan Partners, specializing in early childhood education, and he knows the long history.
Some of the first and earliest investors in early childhood education started back in the 80s. The two largest players today, KinderCare Learning and Bright Horizons Family Solutions, received investment from private equity firms late 70s, mid 80s, and really served as bellwethers for what has become over the last couple decades a much more active and vibrant private equity investment community focused on early childhood education.
What about the nature of the marketplace in early childhood education makes it attractive for private equity? I mean, what's the opportunity?
It is a capital-intensive market that requires a degree of professionalism and investment that oftentimes exceeds what individual owner-operators can do themselves. There's also a fair degree of complexity, particularly as you move across states. What they are doing is taking a fragmented ecosystem and striving to drive efficiency and scale in ways that more independent owner-operators are oftentimes unable to do themselves.
But that's not to say that private equity plays as large a role in all parts of the early childcare business. At least thus far, investors have been careful to pick their spots.
The part that the private equity world tends to play in are those two middle segments, the national chains and the independent centers.
Newman estimates that the two segments targeted by private equity, national chains and independent centers, account for about 39% of the children in care today. And he expects that portion of the business to grow to about 45% of the total market over the next 5 years. But all that private equity participation is not without its detractors.
There's a for-profit chain called Guidepost Montessori, and it's a venture capital-backed chain. And what happened is they ended up growing so fast, they got way over leveraged. They stopped being able to pay their rent, and they actually ended up having to close over 40 to 50 of their sites in a matter of months. And then the parent company just a few weeks ago actually filed for bankruptcy. Other countries have seen childcare chain collapses. The largest for-profit chain in the Netherlands in the 2010s, which was private equity owned, collapsed. The government had to step in. In Australia in 2008, the largest for-profit childcare company in the world, something called ABC Learning, collapsed because it was, again, over-leveraged.
On the other hand, those who deal regularly with private equity investments in early childhood care say that in some ways it's the safest form of investment, as investors will make sure things go right for their own self-interest.
If you think about it, the headline risk for a bad investment in early childhood business is pretty significant. If you think about the LPs that sit behind a lot of these private equity firms, the last thing they want to read about or see is an investment made by one of their private equity firms that has had, a pretty nasty headline because of quality or other concerns. So in many ways, a private equity owner theoretically should be bringing a greater degree of rigor and attention to some of those issues. Now, the reality is, as some of these chains get increasingly large, you're still dealing with hundreds of sites, and there is a degree to which you lose control over what might happen at the edges of that network, but that can happen in any environment.
To investors, rolling up childcare centers requires careful calculation to stay profitable. But to parents, the math isn't as important as the care.
Kids are not widgets, kids are not products, and you really don't see the outcome for years to come.
Becca Ballant is now a Democratic congresswoman representing her home state of Vermont. She earlier served for 8 years in the Vermont Senate, including as majority leader and as president pro tempore, where she worked to get legislation passed addressing the lack of adequate child care in her state.
It's been a challenging landscape for many years now. We have a confluence of forces that has made it very challenging for us here in this very rural state. So we have a demographic crisis. We have a lot of elderly folks here in Vermont, not as many young families. You have had a situation in Vermont where there hasn't been enough child care slots in child care centers for the number of people that want to go back into the workforce.
In 2023, Vermont passed a child care bill that provides $125 million of public funding, giving more than 7,000 families access to child care assistance.
Over the early years of this 10-year push, we set benchmarks for ourselves, and some of them were very ambitious, trying to get to a solution by 2025. You had champions within the legislature, you had a governor who also understood that it was holding us back, and you had a Democratic legislature, a Republican governor. It was clearly a bipartisan issue. And then we worked really hard to bring in business partners from across the state in all different industries for them to make the case that this was not just good for the individual kids and their families, it was good for businesses, it was good for the economy. And it's not easy to raise a payroll tax. You can imagine all of the forces at work there that didn't necessarily want to go down that road. But we had so many large-scale meetings with so many stakeholders from across the state saying, well, what are all the different possibilities that we could look at? And in the end, that was the one that we felt like in Vermont was the case that we could make because we had so many businesses already on board. That might not be the case in another state or municipality.
A Vermont nonprofit organization estimates that the law will serve as a $375 million boost to the economy when parents are able to enter or re-enter the workforce. Vermont's efforts may be a step in the right direction, but nationally, early childhood education is still a pressing problem for many American parents. Whatever the risks and opportunities in private equity's growing role in early childcare, for both investors and for children, and their parents. Everyone agrees that it's not the ultimate answer for the lack of affordable care, and it doesn't address large segments of the population where the needs don't match investors' goals.
The portion of the population right now that is probably underserved are not the affluent, but it is probably the bottom two quartiles who are desperately looking for options that are reasonably high quality, but where there's just a fixed number of seats available at the local public pre-K program or the local Head Start program. So I think private equity, increases capacity a bit, but doesn't, I don't think, fundamentally change solving for the demand that exists out there.
That kind of investment is really looking at short-term gains and looking at solutions that are very much oriented towards the economy of the thing. And I think when you're dealing with children, those can't be the drivers. You have kids who are coming from all different backgrounds right now, and it's critically important that the child care facility, that early education site, is meeting the needs of those kids and their experiences as they come through the door. And the experiences of families here in Brattleboro are not going to be the same as families up in Little Fairfax, Vermont, or in Burlington, Vermont. And so that is my hesitation with believing that the solution is private equity investing in these chains. And I also think it's not a great solution for rural America because families want to know the people and the entities that are watching their children. It's the most precious thing that you have.
Coming up, speaking of children, what does that one big, beautiful bill mean for the children of America and the sick? Our special contributor, Larry Summers, tells us why he doesn't like what he sees. This is a story about borrowing from Peter to pay Paul. President Trump's one big, beautiful bill found a way to pay a lot of Pauls through reduced taxes, but taking funds away from Peters, who have been dependent on things like Medicaid. Our special contributor, Larry Summers of Harvard, has been outspoken about what he says it will cost us over the long run.
David, this is the biggest cutback in the U.S. social safety net in history, measured relative to GDP. It's substantially larger than anything that happened in Ronald Reagan's revolutionary 1981 tax cut legislation. It's substantially larger relative to the economy than the welfare reform that took place during Bill Clinton's time. So this is a big deal. It's going to mean that some number, it's hard to evaluate exactly, might be 10 million, might be 12 million people are going to lose their Medicaid benefits. It's going to mean that ancillary services that are hugely important for people, getting a ride to the hospital so they can get their dialysis, being able to go to a rehab facility when they can't take care of themselves, but they no longer need to be in a hospital. That kind of thing is going to be cut back. It's going to mean no economic lifeline for desperately important rural hospitals, some of which are going to close. But here's a crucial point that I don't think has gotten enough attention in the debate. People focus on the moral aspect, and that's important, what's going to happen to some of the most vulnerable among us. But this has consequences for everybody. When people come to the hospital later and sicker, with more that needs to be done, and there's no government support for their care, the bills of all the rest of us are going to go up. When hospitals are filled with people who don't need to be in a hospital, but are there only because there's no other place for them to go, there's less access to care for others when they have an emergency. When rural hospitals close, that means less access, not just for the poorest people. When these costs mount and ultimately have to be borne, that's ultimately going to translate into higher taxes and greater premiums when the people eventually get sick enough that they qualify for the supported medical care. So this is both immoral and wrong, and it is imprudent and is going to burden the American middle class.
It's part of a larger pattern I think many people have detected in the bill overall, which is a shift in wealth from some of the poorest among us to some of the wealthiest among us. We can talk about whether that's a moral thing to do or an immoral thing to do, but what does it mean in macroeconomic terms, in terms of growth over the long term?
David, my values point me towards wanting us to be a more equal society. I don't think that those making estate wills to their children of $30 million should be the beneficiary of new largesse at a time when we've got a massive budget deficit. But I'm going to be honest with you. I don't think honest economists should make all arguments in favor of the policies they prefer. And the reason to oppose this bill is that it's unfair, that it's inefficient, that the deficits are going to do a great deal of damage. But I'm not going to tell you that because of the inequality, we're going to get major reductions in economic growth. Yes, we're going to get major reductions in economic growth because we're on a trajectory to cutting back R&D in very dangerous ways. Yes, we're going to get reductions in economic growth because we're going to cut back support for other kinds of public investment in education and in infrastructure. But the main reason to be against inequality is because it's wrong and because some of the investments you make to reduce inequality have very high payoffs. But while it would support the policies I generally favor, I am not, as an economist, going to say that we have convincing evidence that, as a systematic matter, reducing inequality raises economic growth.
Even as Trump's big bill will shrink the country's social safety net overall, one increase in federal spending will go toward supporting families, including through a single payment of $1,000 for a savings account for newborns. But Summers says he's worried it isn't enough.
My suspicion is that it is so subscale that most of the costs will go into administering the thing relative to benefits that will change people's lives. So I don't think we know yet, and maybe this will be an acorn that plants a very valuable tree that will grow over time, but I haven't yet seen the blueprint that convinces me of feasibility at the current scale.
We put in some of the lowest percentage of our GDP into early care and education in the United States of any developed country, and it's because we haven't yet made that leap from the idea that actually the care and learning of young children is very much a public concern.
Elliot Haspel at the think tank Capita says market forces alone aren't enough to solve the child care crisis in the United States, and the government needs to be doing more.
Childcare is not a market good. Former Treasury Secretary Janet Yellen has called it a textbook example of a failed market. Doesn't work. So you're going to need some sort of government intervention. We can also look across the world and see other countries, including just above us in Canada, that have made major reforms in the past few decades, all of which are underpinned by significant permanent increases in public support of a public-private system to make sure that families have access to good childcare options, that educators are paid well, programs are high quality, and again, that there are guardrails in place to make sure that public money is serving the public good.
Haspel's view that government should play a bigger role in helping new parents is shared by Congresswoman Becca Balint, who was a former teacher herself.
The struggles that working families have right now, they are not the same struggles as people had 20 years ago. You know, you've got young people carrying a lot more debt. They have costs that did not keep pace with inflation. They exceeded them, whether they were housing costs or healthcare costs. So I always say to people, I'm in my 50s. I always say to voters who are grousing about younger families, I say, what they're doing actually is something very different than I did, and what folks in my parents' generation did. That the economic strain on them is more acute. And so there is this understanding that we need to gain, that you've got families who are absolutely stretched. And it is within our best interest as legislators, as people looking for solutions, to see this as part of the ecosystem of the economy and not an add-on. This is how you make economies thrive, and certainly other countries have figured this out before we did.
Even as state and federal lawmakers take steps to invest more in American families and childcare, Summers says we shouldn't be looking to Trump's big bill to save our kids. The costs might well outweigh the benefits, especially for future generations.
I think the borrowing that we're engaging in and the risks that poses to the economy may well do more harm to my children and my one-year-old granddaughter than the putative new programs that are contained.
Up next, the World Cup is coming to North America in a year's time. Cities across the U.S., Mexico, and Canada are stepping up big time to make it possible. But is the investment likely to pay off? That's next on Wall Street Week. This is a story about the beautiful game. From Maradona to Messi, Pele to Puskás, the biggest stars in the world have left their mark on the FIFA World Cup. And whether you call it football or soccer, the world will be watching as new stars are born when the U.S., Canada, and Mexico play host next year. While many of us will be focused on who wins on the pitch, the 16 host cities face a challenge to make sure they win off of it. The FIFA World Cup is one of the biggest spectacles in sport. 48 teams, 104 matches, one winner. Or maybe two. Sure, one team will lift the iconic trophy, but with an estimated $11 billion in revenue coming in, FIFA might be the real winner before a single ball is kicked.
It's the biggest event ever. It's more than 4 billion viewers all around the world, and we will make it the biggest, not only sports event, but the biggest social event that we can think of.
Johnny, we're going to have to extend my second term because 2026, I'm going to have to extend it for a couple of years. I don't think any of you would have a problem with that, but I hope you're going to remember me in 2026.
For sure.
Since the World Cup was awarded to the U.S., Canada, and Mexico during President Trump's first term, 16 host cities have been ramping up infrastructure spending to prepare for the tournament.
I think as a host city, we know this is a big investment.
Sharon Ballenbach is the executive director of the FIFA World Cup 2026 Toronto Secretariat.
Our budget here in Toronto is $380 million, and that has been approved by council. It is, in terms of funding partners, we have significant funding partners from our federal government, as well as our provincial government, and then, of course, the City of Toronto. So it's really all three levels of government are contributing. And the City of Toronto's portion is around $180 million. And much of that comes from so that we can reduce the burden on sort of the tax base. Much of that portion that the city is contributing to the event is coming from some reserve funds. We're putting in place a municipal accommodation tax as a source of revenue for a temporary period over the course leading into the tournament and for the couple of months after. As well, we have a big commercial revenue strategy around bringing in host city supporters and other hospitality sales and opportunities for corporate and other businesses and so on in the city.
Toronto's upgrades include better public transit and the development of training centers, but a sizable portion of the budget is going towards upgrading BMO Field, where Nick Eves is the chief operating officer.
FIFA minimum requirement is to get the stadium up to a 45,500 capacity. Today, the stadium holds about 30,000. So we'll be building a temporary 10,000 on the north end, another 7,000 on the south end. The north end structure, in addition to that temporary seating, will also have a permanent 2 levels of hospitality suites, which of course will be usable for the World Cup matches. All of that work must be complete by March in order for us to then go and host some test matches here to really sort of dry run and experience some of this new infrastructure that's been put into place. So on the first phase of construction, we're on schedule. We will be on schedule for the second phase because ultimately we have to hit that March date to host the test matches. And then we need to hand the stadium over to FIFA 30 days from the opening match.
As it turns out, FIFA requires a lot from hosts beyond just stadium capacity. In a published list of government guarantees, FIFA lists the, quote, significant mid- and long-term socioeconomic benefits for host countries, using that to justify a list of requirements that include tax exemptions for the tournament and support in security, public transport, and infrastructure. And it also takes over external advertising spaces. So Toronto's BMO Field becomes Toronto Stadium, and MetLife Stadium becomes New York, New Jersey Stadium.
It's the biggest, broadest, most diverse, kind of far-reaching World Cup there has ever been. And so with that has come a lot of learnings. And I think FIFA have learned a lot, quite frankly, as well, about working with 3 countries, working with 16 host cities. So there's been some things and elements of the agreement and of the requirements that have been laid out from day one. There's been some elements that have shifted, and that's been open dialogue and open communication and an understanding of what are some of the realities that are happening in Toronto that might be different than the realities happening in Vancouver or happening in Los Angeles or happening in New York or Dallas. So there's been some shifts and some ability for us to work together with FIFA to determine what some of those things are. But FIFA definitely, this is their tournament. This is their tournament. They own the property, as it were. And so they will come in, I think it's early May, and sort of take over the stadium. They will manage their portions of this tournament and work with us. They understand our budget. They know what our budget is. We've had to push back on some things. There's been some good dialogue on some of the items where we just don't have the budget to maybe meet some of the requirements that have been in place. And so that's been a bit of give and take. What are the primary things that we want to make sure are in place, and what are those things that maybe we can adjust and change a little bit? So that's, again, been an open dialogue. FIFA, I have to say, have been great partners. We've had the ability to really discuss openly some of the elements, understanding it's their tournament, and they've run it for many, many years, as we all know.
And FIFA certainly knows how to make money off of it. The $11 billion in revenue it expects to receive will come largely from broadcast deals, ticket packages, and sponsorships. Andrew Zimbalist is a professor of economics at Smith College and author of Circus Maximus, the economic gamble behind hosting the World Cup and Olympics. There's a good deal of revenue that doesn't come back to the cities who are sponsoring these things. Particularly, it goes to FIFA. What happens to the money to FIFA? Where does that money go?
Well, it goes to making sure that Gianni Infantino has a very comfortable and luxurious life, for one, and his various deputies. But more importantly, the vast majority of the money goes to soccer federations around the world. So each of the participants in FIFA, the International Soccer Association, each of the country participants has a national soccer association, and they're in charge of developing soccer in their country. They spend money for youth soccer programs. They spend money for facilities. They spend money to train referees and officials and so on. So most of the money, the overwhelming majority, probably 90% of the money that is generated for FIFA gets reinvested back into the soccer development worldwide.
So where do the host cities see a return? They get none of FIFA's windfall, but expect to make money through revenue streams like increased tourism, job creation, and global exposure. For Toronto, that's expected to result in $686 million of positive economic output for the greater area, according to a report from Deloitte and FIFA. Adam Van Koeverden is Canada's Secretary of State for Sport and a former Olympic champion in kayaking.
It is a big upfront investment, but we know that it's going to pay off. For example, the federal government is investing $220 million between Toronto and Vancouver to ensure that these 13 games are world-class, safe, and really, really exciting for Canadians. The provincial governments are also coming forward with hundreds of millions of dollars, and the cities are also investing, as are private companies, and FIFA especially. So it's an exercise in collaboration, like I said, but the result is a massive positive economic output that Canadians, Canada, Canadian businesses, everybody will see the benefit from that. Likely, we're going to see about $2 billion increase to our GDP, as well as about $3.8 billion, upwards of $4 billion in positive economic output. We're talking about almost 25,000 jobs to be attributed to the FIFA World Cup in 2026. So the economics are very, very sound. It looks like it's going to be a huge boon for Canada's economy, but I'm sure the same is true in the United States and in Mexico as well.
Yet not everyone is convinced.
So you put the costs and the revenues together, and you can get a variety of different outcomes, but more likely than not, there's not a financial benefit for the host city. Although virtually every one of the 16 cities in North America will have an increased flow of tourism into the city, virtually every one, I suspect. Very often, the soccer tourists, the soccer fans, replace the normal fans. So somebody who might otherwise be thinking about a trip to Vancouver, Canada, to watch some of the World Cup games might decide, gee, as nice as Vancouver is, and it is a great city, as nice as it is, I'm not going to go there when the World Cup is happening because I'm not going to be able to get a ticket to the game, or I don't want to spend $500 to get a ticket to the game. And so why would I want to put up with the congestion and the higher hotel prices? And so what happens is the soccer tourists substitute for the normal tourists. The normal tourists are the ones that spread the word best about the city. And tourism in cities is best advertised by the actual visitors who come and they go home and they talk to their friends, neighbors, and relatives about what a nice city it is and the different pleasures that they had when they were in the city. If the World Cup tourists are replacing the normal tourists, that's not good for long-run tourism as a general principle. But the other thing that's true is that FIFA requires the host city to basically cancel all sales taxes and related taxes on things that are related to the games. If the tourists come to the city and they go to what's called a fan fest for the World Cup in the city is required to put on a fan fest, and they buy things at the fan fest, say they buy food, that's money being spent on hamburgers and hot dogs that's not being spent at a normal tourist restaurant in the city. A normal tourist restaurant in the city will produce sales taxes and revenue for the host city. But if it's being spent at Fan Fest, there are no taxes allowed. Same thing with ticket prices. They're not allowed to charge a sales tax on ticket prices. So the city can actually be losing money because if they were playing a normal sport in the summertime and people were buying tickets, there'd be a sales tax on that. That would be revenue to the city. But when they're hosting the World Cup, they're not allowed to have that.
There's a lot of talk about long-term benefits from hosting World Cup games. How sure can we ever be that, in fact, it's worth it?
There's always the hope when you host a sport mega event and you're put, in quotes, onto the world stage to a degree that you hadn't been before. There's always the hope that there'll be more people around the world who now want to visit your city, and there'll be more companies around the world who now want to trade with them for your products. And there'll be more investors around the world who now want to invest in your city. We don't have any evidence that happens. Those claims have been made frequently. They were made certainly abundantly in the case of London in 2012 when they hosted the Summer Games. But there really isn't any evidence. Good companies don't trade with a city or with a country because they hosted a sport mega event. And they don't invest in a city for that reason. They invest in cities because they have good resources, because they have a good labor force, because they have good fiscal legislation, and because they have good transportation and good location vis-a-vis their markets. And I think that if everything aligns properly, if the city already has the ready-made soccer stadium or stadiums, and they already have the transportation infrastructure and the security infrastructure, and FIFA is giving them some of the more interesting games during the course of the World Cup, then the revenue side could go up a little bit and the cost side could be moderated, and at the end of the day, maybe they generate a small surplus.
Ultimately, surplus or not, the World Cup's reach goes far beyond the spreadsheet. And perhaps few know that better than Canada's Olympic champion turned politician.
I know the power of sport. It has the power to change lives for the better. When we invest in physical activity programs and recreation opportunities for young people, for families, and for older folks alike, we get positive social outcomes. But we also see the economic benefits. We see reductions in healthcare costs. We see less of a strain on our judicial system. We see kids happier, healthier, and more connected, and our communities really coming to life. And that's what I expect to see with FIFA. When it comes to town, we're going to celebrate the beautiful game. We're going to celebrate the opportunity to play host for 6 incredible games here in Toronto and 7 across the country in Vancouver. But I know that in every city across Canada, you're going to be celebrating the great game of soccer.
Much has been made in recent years about the booming business of sports, and next year's World Cup looks set to be no different. But perhaps the lasting legacy of a successful tournament won't lie on the bottom line, but what happens inside the white lines. That does it for us here at Wall Street Week. I'm David Westin. See you next week for more stories of capitalism.